Kavita was watching Money9 and asked Ashish whether he saw the news that the government has ended tax concessions on debt mutual funds. She wanted to know what that actually means. Ashish told her that tax rules for mutual funds have changed. The government has ended long-term capital gains tax on mutual funds. Now, any kind of profit in such fund will be taxed according to the tax slab of the people. Kavita said that it's just like how FDs are taxed, so she was confused about why she should invest in a debt fund. It's better to invest in FD. Ashish said that he also feels debt funds will lose their charm. Who will prefer it if they are taxed like FD? Just then, market expert Gyanchand walks in and asks why are they debating about debt funds versus FDs. Kavita told him about the news that tax rules on debt funds have changed. Then Ashish chipped in that Gyanchand is expert in market matters, so he should tell whether to invest in debt funds or not. Gyanchand said that it's true that changes in tax rules will impact debt fund investors. They will be taxed just like FD. But still, there are many such funds in which you can avoid the effect of new tax rules. One such fund is Balanced Hybrid Fund. Kavita got curious about the Balanced Hybrid Fund and wanted to know more about it.
As the name suggests, a balanced hybrid fund maintains a balance between debt and equity investments. In the year 2017, SEBI created a new subcategory, Balanced Hybrid Fund within hybrid funds. According to SEBI regulation, between 40 to 60% investment in a balanced hybrid fund can be invested in equity or equity-related instruments, and the rest can be invested in debt instruments. They are open-ended funds that invest in both equity and debt instruments. Such kinds of investments include shares, bonds, money market instruments, etc. The objective of these funds is to create a balance between returns and risk. Hence, they invest in both equity and debt instruments. They are more stable amidst the market volatility than pure equity funds.
The manager of hybrid fund is always very careful that equity-debt ratio of the fund is in line with SEBI's definition. Fund managers try to get a high return with equities, and with debt components they try to manage the risk. This way, with balanced allocation, you will get the benefit of portfolio diversification and you won't have to invest in the different asset classes. It is believed that in medium term, like 5 years, balanced hybrid fund can get you good returns. Keep in mind that balanced hybrid fund is not completely risk-free. Since it invests in equity, it has some element of market risk. However, they are less risky than a pure equity fund. Let us see how balanced hybrid fund is taxed. In these funds, equity component is more than 40% but less than 60%. Hence, these are known as non-equity oriented funds. If invested for less than 3 years, then it is known as short-term capital gains and you are taxed as per the income tax slab. However, for more than 3-year period, there is a long-term capital gains tax of 20%. You also get an indexation benefit. Balanced hybrid fund have given good returns. However, you should keep in mind that there is no guarantee of return. As per value research data, in the last 3, 5 and 10 years, balanced hybrid funds has given 29%, 12% and 14% return respectively. Now the question is, who should invest in balanced hybrid mutual fund?
So balanced hybrid funds is a special category of funds where there is an allocation made between equity and debt. Now that allocation will depend on your risk appetite. There are aggressive hybrid funds where the allocation to equity will be roughly in the range of 65 to 75% and the rest will be in debt. There are conservative hybrid funds where the allocation to equity will roughly be around 30% and the rest 70% will be in debt. And then there are balanced advantage funds. So in balanced advantage funds, the allocation between equity and debt is dynamically managed. If market valuations are high as per the fund house model, then equity allocation is as low as 30%. And if valuations are very attractive as per the model, then the equity allocation can go to even 80%. So such funds keep varying the equity allocation every month, every quarter, depending on the market attractiveness. These are basically 3 categories of balanced hybrid funds which are available in the market.
This is apt for investors that are looking for balance between wealth creation and low to moderate level of risk. Specifically, if you are looking to buy a car, house, or need money for a child's higher education in 5 to 7 years, then you can achieve your goal by investing in this fund. Similarly, if you are looking to take a lower risk and you are not active in managing your portfolio, in that case also, this fund is right for you.
Debt mutual fund investors need to understand that funds purchased after April 1 will attract short-term capital gains tax, irrespective of the investment horizon. Hence, financial advisors and distributors might promote such hybrid funds more aggressively, in which there is a debt component but are considered as equity funds from a tax point of view. Balanced hybrids are such kind of funds. In order to get good benefits from these funds, investors should invest for the long term. If investors are still confused regarding which fund is better from the tax point of view, then he can consult a financial advisor.